So guys, on this week and the next one, not only this one, we will review the financial forecasting. For what? As I told you, the balance sheet and the income statement. Now you know the purpose of why we do a forecast, and we will review the steps in performing the percentage in sales method. This is the first method that we will review. It's one of the most common methods. For sure, 80% will manage it, your forecasts and budgets this way. Financial forecasting is to predict position of a company in the future. Therefore, the purpose of the financial forecasting is to show the direction of financial objectives of a company. Remember, objectives, balance scorecard. Be alert in all risks facing by a company in the future. Balancing between assets, liabilities, and equities. So you can manage your debt and financing portfolio, and balancing between revenue and expenses. So you don't have a huge loss because you approve a budget with losses. I've seen that, guys. I've seen it. Sorry about that. But so the first thing that we need to know is well, that's what I wanted to review with you before we started this lesson. Let's get back and finish what we were reviewing with Sensience. Remember that these were liquidity ratios. Remember how we did it? How we did them with these formulas? And we have debt to equity ratios and profitability ratios, which are mainly in this section in the income statement. So first of all, guys, please tell me, do you remember these ones? So we missed activity and efficiency ratios. These are related to this topic of creating a forecast, because this is the most common ratios used to do the sales method. Okay, so first thing of all, and I want you to do it, remember that you were doing it, this template by yourself. Please try to do the inventory turns. You have it in the Excel, in the formulas that I put it in the Excel. We can do it directly. Can you do days in inventory? It was a trick question, guys. 162 and 163. It's okay, both of them. I did it different from the formula. Let me try to show you my way. I think it's easier. So you got your average inventory. And why do you do it with the average inventory, guys? It's mainly because what if you have this inventory and then in the next year you have this one? And if you take only into consideration this one, so it covers large deviations in inventory. Well, it diminishes the deviations. What I'm just doing, it's the average inventory divided by the COGS. It gives you the percentage of COGS that the inventory represents. So if we take into consideration that the COGS was recorded on a yearly base, so if we have 360 days per year, so if it represents 44% of the COGS, and multiplying that for the 365 days per year, it will give you 162 days per year. So you have 162 days of inventory in your assets. That means that it takes you at least almost half year to sell. And I will explain why we use these 3 criteria of days, because with this we will get our financial cycle. That means that the cash flow cycle. Remember that we saw that key concept at the beginning. So it's the time that the company needs to convert sales into cash. All the operational days in order to create sales. Cash. And the next one, days sales outstanding. And if you finish, go for the days payables outstanding. Okay. Days of credit, with the days sales outstanding. The ones that got 60, that's the correct answer. What I was trying to show you before, I did not know that I was not sharing my screen, is the final balance of accounts receivables. It's divided by the total level of sales. So it represents 16% of the yearly sales. So if you multiply that by 365 days, you will get the number of days that it represents from the whole year.
I thought we divided the amount of days.
You can do it. If you do it properly, it will give you the same result. I'm trying to explain it my way because I think it's easier to remember it. If you divide the level of credit that you gave, and the credit, it's obviously related to the sales. Account receivable is related to the sales. You've done the records. So if you divide the final balance of the account receivable by the level of sales, the sales are on a yearly basis. So if it represents 16%, it should represent 16% of 365 days for the whole year. Do you agree? Because what we want to get from this is how many years of balance you have in your accounts receivable. So the $218 that you see in 2010 represents 60 days of sales. Your inventory represents 162 days of operations. Remember that the matching principle, when you sell, you put it in the COGS. So it means that if you don't have it in COGS, you haven't sold it. So if the days of inventory represents, it was 40% of the COGS, that's why it gives you 162 days of inventory that you have in your assets. That means that you take almost half year to move your inventory. I don't know how it's been done by Sentient. Let's keep going. And days payable, guys. Days payable. The last one. Payables outstanding. Let's do it. It is 40. It is 40. Same thing. You will take your the first thing is where do you get your accounts payable? Which one is the accounts payable in here?
Trade accounts.
Yes, trade accounts. So you divide that against the COGS, and it represents 10%, well, 11% of the COGS. So if it's 11% of the COGS, multiplied by 365 days, you get 40 days of your payables outstanding. This means, guys, that if we take into consideration that we give credit of 60 days to our customers. Take a look at this. This is the important message for regarding the efficiency ratios. More than you can compare them, because you can, as I show you, the purpose of the ratios are to assess financial performance and to compare it with your competitors. This also lets you know how many days you need to wait in order to create cash flow. What did I just do? If I know that I have a financial cycle, this is the financial cycle. This is not in the formulas in here. Huh? I don't see it, but this is the important message. So if I know that I move my inventory in 162 days, that means that I have to wait this amount of days to sell. Do you agree? Perfect until there. So if you wait 162 days, yeah, I sold in 162 days, but I give credit to my customers for 60 days. So you have to wait 262 days to convert everything into cash. It's 220, sorry, days to convert it into cash. But you have also a days payable that is giving you credit. Your supplier gives you 40 days of credit. So at the end, you balance that out and you get to the final result of you have to wait half year in this company to convert operations into cash. This is meaningful and valuable information because it means that without knowing this company at all, we could potentially have cash flow issues. Imagine that it takes half of the year to convert cash operations into cash, but you have to pay the payroll on a monthly basis. Where are you gonna get that cash from? Remember that the final lesson that we saw, it was vertical analysis. Vertical analysis. Very easy, very easy. It's just dividing each line of the income statement for the total amount of sales. Remember that? So it means that my operating income, it's gonna be 13%. And we also saw the multiple analysis in order to properly get how much you can get from your company. Remember this one? The multiple analysis? Because what the investors usually give to you for the value of your company is that multiple by the last figure of your EBIT. That's why the EBIT, it's a very common track KPI of companies. So I will give you for your company $692 according to this figure. Remember, guys, this is the vertical analysis. It is very important. This is a very common use tool. Why? Why? Because imagine if I'm able to do this. And this is the important lesson of today. This is the first lesson of forecasting, guys. We will do the first forecast. So keep on with me. What we can do, and correct me if I'm not making sense out of this. So do you agree that this is the average for the cost line? So if we have a sales forecast, we could just multiply it by the average margin from the previous years, no? So if I don't know, I will made up a figure. If I have 1,000, I know that for 1,000 of sales, I will have 658 of cost. But the same, how much do you get from selling general and administrative expenses? For 1,000 of sales, of total sales for that year, we can put it as year 2011. How much you get from selling and general administrative expenses?
176.
Okay. Let's see. Wait. Also fix this. That easy, guys? That easy? That's how we forecast? I thought it's gonna be rocket science. Well, this is the most common method used to forecast. So we have created almost.
Teacher, for the total, what did you do?
Let's review it. Yes. Did everybody got the same response? The same answer? Just put the okay. Actually, this one. Give me 1 second. I think I did wrong. Yeah, I did wrong. Sorry, guys. This is the correct answer. That's why you don't use in this formulas the same as this one. Do you want to review it, guys? It's just 1,000 multiplied by 65%, which is the average of these two. It gives you the 658. The same with the selling general administrative expenses. 70%, that represents 166. The 76. The same with depreciation and amortization. You no, this should be add up. What am I doing, guys? What am I doing? Sorry for that. This happens with when you forecast. You have to double check your your formulas. Yes. So interest expenses, perfect. It's good. Other operating expense and income, yes. Plus, yes. EBIT plus interest and non-operating expenses. Okay. This is the important thing of analyzing on a vertical way. Vertical analysis is very important. This is what we see. The gross profit tells you what's your gross margin, that it's basically what you earn per each sale. And then you have your fixed expenses. They could be variable, but You have your fixed expenses in here. In the total operating expenses to get to the operating income, and this is what you get almost for cash flow. If you add up depreciation and amortization in theory, that's what you get in cash flow from operations. When each each half year. Did you saw how we just forecasted 2011? So now you can analyze where are you spending the money of the sales. 65% goes directly from the cost of your product. So from each sale, you earn 34% of the total amount sold. So once that you have that 34%, 21% goes away in expenditure. So your operating margin, it's only 13%. So guys, the important message to finish and round up this lesson, the final message is that, yes, it is that easy, but what if I don't give you this line? So the importance of this method is to have or create the line of the net sales, to forecast the net sales. How do you think that you can get that line? What method would you use? How would you forecast the sales? That's where we involve statistics in here. And it is very common that the sales forecast it's provided by your commercial team, okay? But obviously you need to have tools to correct them, because what if they tell you, what if you see this thing on the next year? Would that make sense to you?
No,
Why not?
because the 2,600 is double last year's, and
So that's
the
what you would
difference-
question to your commercial team, that how it's going from one year to the other and double it. Now that we know that the important line is to get the net sales, one and the most common used tool it's trend analysis. We do linear regression analysis. We can see more, but stay with me with just this one. So guys, we can do it two ways. We have data analysis tool in Excel and create it, or I can show you how to create it. This is ANOVA analysis. Have you heard of it?
No.
No.
So you go to data analysis. So go to data analysis, regression. So your y-axis, what you want to find, it's the level of sales. Okay? And your x, it's the number of months. I can change that for the name of the months. Don't worry about that. It will correct it as if there were figures. So remember what I told you, what was the R2 factor, it's the level of confidence. It means that it has that level of accuracy. So you can play with it. You can go with a 99% of level of accuracy, leave it that way. 95%, it's a good level of accuracy. And I want to put everything in this section, so you don't have to open a new sheet. So once you click on it, you get all this data as result. But what I wanted to show you is that this is how it was done before. Now we have an easier way. I gave you this data. This is a made-up data for months. No, years, sorry, years, because we're measuring levels of sales in years. Because this one is 2009, no? 2009 and 2010. Remember? 2009, 2010. And what we want to know is this, 2011. So we have years and we have revenue. No, how it's being called? Net sales. Net sales. What I wanted to show you is there is a very easy way to get it instead of having all this data. But the important thing in this data is that with this statistic, you accept or reject the equation. So please create a chart. Let me see, it's a line chart. Wait, insert. No, it's a dispersion chart. You just have to select all the data from this table. Like, select everything and insert dispersion chart with the line, preferably. You can do it also without the line. So remember that what you wanna get, it's the sixth element. Then the next one, because this is the 2010, 11. This is 2010. This is 2009. So in Excel, so you will click on the line, right click, so it can display these options, and adopt trend line. And it will show you this linear trend function. The trend line, when you adopt, it will show you this display, and you have to select present equation on the graph and present the R value. Remember that R value, it's the level of confidence. So what it's telling me is that with 98% of confidence, the next value can be predicted with this equation. Do you want to see it? It's 108.68 multiplied by the sixth element. That is what I want to get. Remember that the y-axis are the net sales and the x are the years. With 90% of confidence, we can say that the next year we will achieve 1,437 net sales. So if we take that into our income statement, we have managed to create our income statement for the next year, our first forecast, with a confidence level of 98% in the net sales. So guys, now you know how to forecast and how to create an income statement, pro forma income statement. That's why it is important to know a vertical analysis. And the purpose of that is just to find the sales.